Thanks. I'm very happy to be here, and I'm very happy to be invited. And it actually feels a little bit like home for me. I used to work together with Daniel Kanjemi over there of EFG FP at Goldman, and we spent a lot of time looking at things like the constructor and building all sorts of models for all sorts of equity derivatives for many years. So this feels kind of familiar. I was going to talk today about dangerous models, as I said, and this is a very appropriate time to be talking about models, maybe too appropriate. I've received lots of calls over the last month or two from people in the press who want to know if models and financial engineering are responsible for the current situation in the world in general. And personally, I don't really believe so. We've had a credit bubble and the usual burst of greed and enthusiasm by everybody who's been part of the financial supply chain, from people who buy houses in California all the way through to people who are mortgage brokers and lenders and securitizers and investment banks and rating agencies. And somewhere in the middle of all of this, I think people have used quantitative models to value CDOs and to value tranches of CDOs. And I think there is an element of financial engineering in there, but I don't think it's the key piece. I think it's really more a tool of the general, I don't know what to call it, capitalist world and people's attempt to make a profit than it is the cause of it. I don't believe it's the key piece. The Icelandic banks, I don't think, were really sunk because they used too much modeling or too much misestimated their value at risk. I think that really had nothing to do with what happened to them. And certainly they weren't dependent on, I don't think their mistake was relying on a Gaussian distribution. I think the key element really is human nature, and it uses whatever it needs to fuel its sometimes excess enthusiasm, and sometimes reliance on models plays a part in that. But as I said, it's just one part in 10. And what's interesting is that, this is still by way of introduction, what's interesting to me is still that the very people that securitize this stuff, if you look at big firms like Merrill Lynch or Bear Stearns or even Citigroup, held on to their own sort of badly rated securities or wrongly rated securities, and were brought down by it and ate their own cooking, and didn't just pass it on to other people. So in a sense, that's good. I think people ought to bear the consequences of if you want to have the upside of risk, you have to have the downside of risk as well. But I want to talk about models in general. I've always, as I said at the beginning, been a derivatives practitioner. And one of the things I've discovered, this seems to me, from listening to the questions all morning, to be a very educated audience, so at least as far as derivatives are concerned, so maybe I'm preaching to the choir. But I've discovered that people who haven't seen models used in practice, and that includes a lot of academic economists as well as people with backgrounds like myself in physics who initially come from a hard science to the financial markets and don't understand, no matter how smart they are, that the way models are used in finance is not the way they're used in physics or in the natural sciences, and don't understand how well they work. And that's kind of a pet peeve of mine. I think many people have a wrong mental model of how financial models are used, and so I'm going to talk a lot about that today. I may exaggerate a little, but I really do more or less believe what I say. Physicists are really used to models that, let me put this up over here. Physicists are really used to models that predict the world to incredible accuracy, you know, to 10 significant figures if you do atomic physics. And when I began to work on Wall Street, which is more than 20 years ago, 21 or 22 years ago, I naively assumed that it was possible to achieve the same sorts of accuracy in finance and in financial economics as you could do in physics or applied maths. And I thought you could apply the same methods with reasonable success. And I think many people who came afterwards, I noticed, assumed the same. I came to Wall Street, as I said, in late 1985 from a previous life as a theoretical physicist, at a time when the whole investment banking industry was really just beginning to embrace quantitative methods. And long before firms like LTCM and D.E. Shaw and Renaissance Technologies, all in the news for the last 10 years, even existed, and long before quantitative models were really de rigueur or part of the whole environment. They were just beginning to catch on. And headhunters, I discovered only years later, used to call us POWs, which stood, I found out, for physicists on Wall Street. But we really were POWs in a sense, we didn't fit in very well, I think, and we were imprisoned in those days. when I arrived at Goldman in 1985, I started out as a physicist, and then for a few years I worked at Bell Labs in software, which really had nothing much to do with physics and not too much to do with finance. And when I came to work at Goldman, I got very excited because it was very interesting and it used a lot of the same techniques that physics used. I worked in fixed income research, and I got quite excited, as I say, and I read like crazy. And I remember getting into the elevator one day with a colleague of mine and being excited, and I'd been there a month, and starting to talk to him about duration and convexity. And he sort of moved away from me, and this was in the elevator in public, and he kind of moved away from me and sort of looked the other way and then said to me, what did you think about the Yankees game last night? And then I slowly began to realize that, actually quickly I began to realize that I was sort of outing him in some sense, and exposing him for what he was. And then I began to realize that there's something a little bit shameful. I don't think that's the case anymore, actually. This all changed after the dot-com bubble. But there was something a little shameful about two consenting adults talking to each other in public, in front of salespeople and traders about Unix or C++ or anything much more complicated than that. And there was something awful about being outed as a quant in public. Everybody looked away from us. I think things have kind of changed, but not entirely. I worked at Goldman still until 2002, and I think starting around 2000 things changed. But I clearly remember there was a time when people in the groups I worked in were reluctant to put their email addresses on their business cards because that kind of was a brand of Cain in some way. And that's obviously changed. Even CEOs have their email addresses on now. And I also remember I used to work on the convertible bond, with the convertible bond desk, and I remember standing on the desk one day with a colleague of mine, and we were talking about convertible bond models. This must be still maybe 1996 or 1997. And the head of the trading desk walked, I was standing here, my friend was standing there, and he walked with his head between us, and then he sort of grabbed his head and said, the force field, I can't stand it, it's like too intense. And he thought it was a compliment, but it's a kind of a backhanded kind of compliment. Still talking about history, the only good response I ever saw to all of this was a long time ago. Around the time I thought of going to Goldman Sachs, there was a guy called Stanley Diller, who I'm not sure if any of you remember, but he was, at one point he was head of financial strategies at Bear Stearns a long time ago, and before that in charge of the group at Goldman. And there was an article by him about him in 1983 in Forbes, I remember, which I read when I was thinking about making a move. And the guy who interviewed him said it was all about quantitative methods, and he had been a professor in the business school at Columbia, and they said to him, what degree do you have? And he said back to them, a PhD, but don't tell anybody because they'll knock $500,000 off my pay. So anyway, things have improved now. People in quantitative areas, they really have changed. I see the students that come to Columbia, and whereas when I began to move into this field, people were happy to end up programming somewhere near a trading desk and helping them. Now the students are really pretty savvy, and they want to become traders or salespeople or structurers, and they know where the business side and where the money side of the business is, and that's what they try to head for if they can. And I think that's partly happened because people saw the technology bubble and suddenly saw people with IT skills, which they used to look down on as simply being a tool, as suddenly being the source of great profits, sometimes for a long time and at least for a while. And then funds like D. Shaw and LTCM and Goldman Sachs Asset Management and AQR and Renaissance sometimes made lots of money, and even more impressively, sometimes lost lots of money as a result of their quantitative models. And there's nothing like wreaking destruction to get you some sort of respect from the world, even if it's not exactly the respect that you want. But now things seem to be swinging the other way. So let me give you a brief idea of what I'm going to talk about. I was going to talk about models in general, and I was going to first talk about model airplanes, and then models in physics, and then try to contrast them with models in finance. And then, speaking about physics and finance, try to compare the scientific foundations of finance with the scientific foundations of physics, and getting ahead a little, come to the conclusion that there's really only one law of financial modeling, which I'll come to, and then talk about the risks involved, a little bit about CDO models, and what I think is the right way to use modeling and to think about modeling. So let me start with model airplanes. When I was in grade school, I don't know I don't know the average age of people here, but when I was in grade school, we used to build balsa wood models of airplanes and put propellers inside them and wind them up with rubber bands. Anybody still remember that? I don't know. Yes? Okay, so we used to buy them, and they came with a frame with a piece of balsa wood that you had to cut out on the stamped lines and bend them and pin them on a piece of wood with pins and put airplane glue to bind them together. And then once you put the whole thing together, we used to cover it with tissue paper, which you then had to sprinkle water on to make it shrink so that it would become taut, and then paint it with enamel paint, and put on wings, and finally drill a hole and put a rubber band through the nose block onto the propeller and wind it up, and if you were lucky, it would fly for about 10 seconds. You were really supposed to be very careful. I never was, but you were supposed to rub off all the excess glue, and some people made them really beautiful, but I was happy if it just managed to get into the air for a little while. And I sort of think about it in the sense one uses the word model over there too, and what's actually model about this whole idea of a model airplane. The plane I built was called a Zippy, and I actually never found out whether there really was a plane called a Zippy or whether just the model was called a Zippy. But assuming there was a plane that actually was a real airplane called a Zippy somewhere in the world, what was the relationship between the thing I was building and the actual plane itself? They were made out of totally different materials. Mine was made out of balsa wood and glue and paper for the fuselage. But it did capture two essential features of the real plane, and that was it looked a lot like it on a small scale, even if it wasn't made out of the same material, and it could, if only briefly, fly. But it wasn't the real thing. It was a model, and it lacked seats. It lacked ailerons, it lacked a door, it lacked windows, it lacked all sorts of things that the real plane, if there was a real plane of that kind, actually had. It did have, what it did have was a few of the important features, and what features were important depended on who you were. If I'd been sort of 4 years old, I would have been happy if it just made a vaguely airplane-y sort of sound or a throaty sound and could have pushed it up and down and carried it in the air. When I was 10 years old, I really wanted it to fly. If I'd been 15, I probably would have wanted it to be radio-controlled and fly much more impressively and realistically. But the key thing was it had to capture some features of the real plane, and who the user was depended on what features you wanted. If I'd been an aeronautical engineer, it would have had to be a lot more realistic and be able to test its lift and how much power you would need to get up into the air. But whatever it was, it would have been a model. And so what was important about the model? First of all, it seems to me the user and his needs. I said over here, I don't have a pointer, but somewhere up there. The user's needs were important. What aspects of the plane and its surroundings were you most interested in emulating in the model? Because you couldn't capture everything. So, as I said, a flight engineer needs a totally different model than the one a child needs. Secondly was construction and engineering. How are you going to put together this model reliably and efficiently and effectively with as much accuracy, not overall, but as much accuracy in the key features that you wanted to reproduce? And thirdly, there was science somewhere below there, because it had to be able to fly. And even the Wright brothers, I think, although they may not have known the equations of fluid flow and the Navier-Stokes equation and all the equations of hydrodynamics that show you that flight is possible from a theoretical point of view, nevertheless, the whole fact that the thing can fly is, and certainly when one builds airplanes now, one has to take into account Newton's laws and aerodynamics and figure out exactly what you need to make it fly safely through the air. So my main point over here is that really the model, whenever you talk about a model, whether it's a model in the sense of a model airplane or a model in the sense of, you say somebody's a model, perfect model of a modern major general from Gilbert and Sullivan, you're always talking about something that's got some attributes of the real thing, but not the thing in itself. Whoops. Okay, now I want to switch a little bit. Having talked about models in general, I want to talk a little about models in physics, which is the area that I grew up in and went to graduate school in before I ever switched to finance. And I think deep inside anybody who works in physics or who works in chemistry or biology or any of the hard sciences recognizes that the purpose of building models and of trying to construct them is divination in some magical sense, you know, to foretell the future and to try to control it. And I'm going to argue later, getting ahead of myself, that that's really not the point in finance at all, although it looks very similar. And although finance looks a lot like physics, I'm getting ahead of myself, but I want to say it now. Although finance looks a lot like physics, it really doesn't have the same aims. So the main purpose, as I said, is divination, of finding out how things are going to behave in the future. And in physics, there are really at least two, maybe three ways of trying to build these kinds of models. There isn't just one way as there is in finance. And the first kind of model I want to talk about is the second red bullet, is what I call sort of fundamental models, or maybe I should even call them fundamental theories. What physicists mean by a fundamental model is a model that's really got dynamics beneath it and tries to describe the dynamics that determine and control events in the world or in the universe. And a model or a theory consists of a system of principles, often formulated, actually always formulated mathematically these days, and that are then used to draw causal inferences about the system that you're interested in. So the key words are, I said over there, are dynamics, which tells you how things work, and causality, the laws of how things work, and causality, which means if you start from some point, you predict what's going to happen in the future. Fundamental models are often really, if they're successful, people call them theories because they really do seem to describe exactly what's going on. And I'll give an example. But it's a little bit fundamental models are almost a little bit, if you want to be pedantic, they're almost a little bit like religion in the sense Moses coming down from the mountain and saying, you know, these are the 10 commandments and this is the way the world works, the principle of least action, or Newton's laws, or quantum electrodynamics. And let me give an example of one that probably everybody's seen in taking high school physics, which is Newton's laws, and I wrote them down over there. The first one on the top says force equals mass times acceleration. So that's the law of causality, which says if you know the force, you can work out the acceleration and describe the trajectory of a planet or of a rocket or of a satellite or the orbit of a planet around the sun. And the second one is the law of gravitational force, which is what goes in on the left-hand side, which says that planets or all masses attract each other with a force proportional to the product of their masses, big M and little m, and divided by the distance between them squared. And these really are laws of cause and effect. The force produces the acceleration, which is the cause and effect, and then the second line actually tells you the formula for the force, and it's really a theory more than a model. Another way I like to look at this, just in relation to finance, is that these are really models or theories of absolute value. They tell you this is the way the world behaves, and you don't have to compare it to anything else. It's a primitive. It starts from the bottom and doesn't rest on anything else. So they're kind of like models of absolute value. It's almost as though you could just say this is what a stock is worth, or this is what a stock is going to do, not this is what a stock is worth relative to some other index or something like that. So, okay, this works very well. There are corrections to it, and general relativity is supposed to be better and is better, and string theory, if people ever find out that it's true somewhere over here in Switzerland when they open up the Large Hadron Collider, then maybe that'll be even a better approximation to the truth. But to all intents and purposes, this is a theory that works to multiple significant figures, and there's almost an identity between the theory and the world. You can't imagine that there's a world and there's a theory. You almost say the world and the theory are the same thing. The second kind of model, class of models, which I want to talk about, are what physicists call phenomenological models. And it sounds like a mouthful, but it's the word that physicists generally use to describe models that deal with phenomena. And they're very different from fundamental models. They also intended to explain the way things work. They also intended to put in some dynamics and put in some causality, but they kind of take a pragmatic approach, or they're almost like metaphors or like analogies, in the sense that whereas fundamental models say this is the way the world works in an absolute sense, here are Newton's laws, sort of let there be light, phenomenological models, and I'll give you an example in a second, but they say more like, if you want to understand this part of the world or this part of the universe, it's convenient, but not necessarily 100% accurate to think of it as being a lot like this other thing you already understand. And if I can give I don't know, the only good example I can think of is people think of the nucleus inside an atom, which is, an atom is 10 to the minus 8 centimeters wide, and the nucleus is 10 to the minus 12 centimeters wide, 10,000 times smaller, and it really consists of protons and neutrons all packed tightly together, and it's really a bunch of individual particles, but packed so densely that 50 or 60 years ago, people got the Nobel Prize for something called the liquid drop model of the nucleus, which says that to a good approximation, you can think of this dense concoction of protons and neutrons, say at the center of a uranium atom, as really being a lot like a liquid drop. In the sense there are 238 nuclei in there, and if you look with slightly blurred eyes, you can think of it as a drop that can oscillate and rotate and vibrate, and will have normal modes of vibration that are related to the excitation energy levels of the nucleus. And what their model does is calibrate, in the sense that the previous speaker was talking about, is calibrate the parameters, the elasticity and the mass of this liquid drop to things you already observe about the nucleus. And then once you imagine it rotating or oscillating or vibrating like the oceans on the surface and having tides, you can predict excited states and new energy levels of the atom and of the nucleus, and understand something about it and make predictions. But it's sort of an analogy in the sense that you don't really mean the nucleus is a liquid drop. You mean it's convenient to think about it like a liquid drop as long as it doesn't vibrate or rotate too fast and come apart. And maybe even come apart, you can think of it as fissioning, as like one drop splitting into two different drops when it starts to get excited. But it's not the absolute truth. It's an analogy or a metaphor or clearly a model, more than an absolute theory. And so I like to think of these as models of relative value in a way. You're not saying let there be light or F equals ma. You're saying if you already understand liquids, you can think about this collection of nuclei as being a lot like a liquid drop, but it's only an analogy, and don't push it too far or you'll get into trouble. Okay, and the third class of models, which I think really don't exist in physics, but I'm going to mention them anyway, are really statistical models. In physics, people mostly use statistics to figure out the value of parameters that go into the models by doing some sort of least squared fit to the data. And I never, until I came to finance, which is sort of really, I don't know, more like sociology to some extent, or not one of the hard sciences, but a soft science. I never heard people use the word model for statistical regressions, but that's what people do in finance. And I'm not saying that's not useful, but there's no dynamics over there, which is, I think, what constitutes sort of real science, in quotes. There's correlation and there's relationship, but there's no, and people, I think, even when they write down regressions and say prepayments regress against the slope of the yield curve or the level of interest rates, they've got some sense of dynamics underneath there in terms of what, for example, mortgage owners will really do when they prepay or what they think about, but there's no actual dynamics written into some sort of equation. There's just a correlation. And that's the simplest kind of modeling, and it's useful, but and I think that's what happened a lot in CDO models, which I'm going to talk about later. But it's not models in the same sense as the previous two cases I was talking about. Let me move to instead talking about models in finance now and try to make a contrast. So I want to start by sort of thinking aloud about what's really the point of a model in finance. In physics, I said the point was, in physics or in any of the sort of mathematical sciences, the point of a model is, as I said, to predict the future, to understand the dynamics, to use causality to say, if you start from here, where are you going to end up with a rocket? Or in particle physics to say, what particles might you see that you've never seen before? And it sort of works. In the sense people build models and predict the existence of new elementary particles and then go ahead and do experiments and discover them, or predict how you can shoot a rocket to Saturn or to the moon and have it land and come up and have a pod come up again. In finance, if you work with a trading desk, you pretty soon realize that while the economists in some other part of the bank are maybe doing the prediction about about what's going to happen to the economy, most of the trading desks, and particularly in derivatives, don't really pay too much attention to them. And it takes only a little bit of experience once you work with these people to see that the point of a model is very different. So I sort of made up a toy example for a prototypical model. It's based on New York City, but imagine that you know the price of a studio in Battery Park City, which is a area where lots of people live near Wall Street. And there are lots of studios and one-bedroom apartments, and say you know the market price for the last trade of a studio in Battery Park City, and now you want to figure out what you should pay for an 8-room penthouse on Park Avenue that you want to buy or that doesn't trade very often. And so it seems to me the way you would go about doing this is, even if you don't call it that, is sort of building some model which would go something like this. If you couldn't look at the newspaper, you would say, okay, the price, the Battery Park studio sells for something like $300,000, and that works out to, I don't know, I'm making it up, say $200 per square foot. And then you would say, okay, $200 per square foot is roughly what it sells for. Now let me extrapolate to the Park Avenue apartment, which is 5,000 square foot, and use the $200 per square foot to come up with an estimated price, which say might be $10 million, and say that's the price I would guess at if I knew nothing. And then you would start to make corrections, which were more rule of thumb corrections to this constant price per square foot model, and say, okay, it's a better neighborhood, it's near the park, there are more doormen and people picking up the garbage, there's more service in the building, there's better views, I'm on a higher floor, there's a better school district. So you'd make a lot of rule of thumb adjustments over and above the model for trying to estimate the price of the Park Avenue apartment. It seems to me the model's critical parameter is really the implied price per square foot. And it really is, in some sense, an implied price per square foot. It's not what it actually costs you to build it. It's not the realized price per square foot. But if you insist on quoting the price, the dollar price of the apartment in terms of this model, which says there's a price per square foot, then everything, every feature of the apartment is subsumed into this one variable, which is price per square foot. It doesn't take account of service, views, the appliances. It just says whatever other variables there are, I'm going to force them to all appear in this one variable, which is the implied price per square foot. And it seems to me that's the way most financial models work. So let me talk a little bit about the other bullet points over there, starting from the top, which what is the purpose or the aim of a financial model? I think the way that property markets use implied price per square foot in the toy model I just gave you illustrates the functions of financial markets more generally, even the ones to do with structured products or options or Black-Scholes. So first of all, I think the three aims, well, there are probably more, but at least three big ones. And the first one is that models are really used to rank securities by value. If you look at all the apartments you get in the world, or you can get even in New York City, they've got different numbers of windows, different views, they're on different floors, they're in different neighborhoods, and they're almost an infinite, but certainly tens of variables that you can use to try to value the apartment and come up with a market price. But you can't really tackle all of that, and price per square foot or square footage is sort of the dominant variable with which you start. So price per square foot lets you take this big range of different apartments with different attributes and many dimensions really, and plot them on a linear scale and say this one has a better price per square foot than that one, or this one has a worse price per square foot than that one. And then after you've ranked them that way, you can start to take account of finer details like I mentioned before, the location, the neighborhood, the exposure, the furnishings, etc. But it gives you a way to start and rank things in a crude way on a linear scale. Similarly, if you look at yield to maturity for bonds, bonds have many different coupons, many different credit ratings, many different maturities. But as a first step, one quotes them all, and in fact uses as a quoting mechanism the yield to maturity, which is the assumed constant internal rate of return that makes the coupons assuming they're going to be paid, and the final principal give you the right present value, and you discount them at this constant rate of return. Even if there is a yield curve and even if there is a term structure, it's ignored to first approximation. And it gives you another way of just ranking a lot of complex securities on a linear scale and then deciding which one is better. The same applies to price over earnings for stocks. Stocks differ in many different ways, but if you quote their P over E, it gives you a first and sort of zeroth or first order approximation to trying to rank them by value, or trying to take a new stock whose earnings you know but whose price you don't know and come up with a reasonable price for it by comparing it to similar companies in the same market. All of these metrics, what they do in the end is collapse a many-dimensional space into a one-dimensional space and let you try to handle things in a much simpler way on the single value scale, and then you start to make pragmatic modifications to it. That's the first bullet point. The second one, or the third one on the screen, says the second one says models interpolate from liquid prices to illiquid ones. And I think this is very relevant to structured products. With structured products, what you're trying to do is value something that's pretty much custom made or over the counter or listed, but there aren't really very many of them because they're idiosyncratic. And models are used less for divination or for telling the future than for trying to find out the price of something illiquid from something that's relatively liquid. In the example I gave before, it was a Park Avenue illiquid apartment given the price of a lot of Battery Park City liquid, much smaller apartments. And what you're doing is using price per square foot to interpolate or extrapolate through a model from a liquid security to an illiquid one. The same thing happens with option-adjusted spread, for example, where you try to use the option-adjusted spread of liquid mortgages to calculate the value of illiquid, more structured mortgages in the CMO market. Similarly, I think that's really what happens with Black-Scholes when you use it in practice, is you're trying to take a liquid instrument, which is a stock whose price you know, and a riskless bond, which is a bank account whose interest rate you know, and use them to extrapolate to what used to be in the early 70s a not very liquid product, which is an option, which is really a hybrid of a stock and a bond, and use the Black-Scholes model and volatility to extrapolate to the price of an option, which if the volatility is very low will become a stock. Sorry, if the volatility is very high will become a stock, and if the volatility is very low will become a riskless bond. And you use the model as a way to interpolate. None of these metrics, whether it's yield to maturity or option adjusted spread or volatility and option price, really does depend on more than volatility, but volatility is the most important ingredient. And none of these metrics are strictly accurate or strictly correct, but they all provide immensely helpful ways of just beginning to estimate value to the 80 or 90% level and then making adjustments. The third point I want to make about models is that models transform intuitive linear quantities into nonlinear dollar values. Your problem with a structured product or even a simple equity option is, what should I pay for example, for an out-of-the-money option that's 10% out of the money, given that I know the at-the-money value? And if you didn't have something like the Black-Scholes model, you wouldn't really know how to extrapolate, and it's very nonlinear to go from at the money to out of the money. And what Black-Scholes does is let you take something like volatility. After a while, you get good about thinking about volatility, and it's relatively easy to say, I think volatility is 20% now, but might be 40 or 50% per year in the future. It's much easier to think intuitively about volatility or option-adjusted spread or default probability or yield to maturity or price per square foot than it is to think about dollars, because one has some intuition about volatility or interest rates or default probabilities, and use the model to convert something you can think about and that varies linearly. You can say volatility might double, but that might have a totally different effect on an out-of-the-money option when it's filtered through the Black-Scholes, so through the Black-Scholes model. And so models serve to take your intuition about things you can think about and filter your intuition into a dollar value and a hedge ratio and a vega and a gamma for things you really couldn't have come up with. Of course, people get more sophisticated. You start by I think when Black-Scholes first came out, before the time I was actively involved in finance, but I'm sure, well, I know they had trouble publishing the paper, and clearly it looked very arcane, and volatility was not part of, and delta and gamma was certainly not part of anybody's everyday intuition. But people sort of play leapfrog with models, and once the model becomes accepted, one can get more sophisticated and start to think about volatility surfaces and the volatility smile and stochastic volatility, and develop intuition about not just volatility, but the slope of the volatility curve or the term structure of volatilities, and eventually build more sophisticated models. So there's a constant leapfrog going on in which intuition gets crystallized into new models, and then new models allow you to deviate from them as the market gets smarter and develop more sophisticated models. But I think the key thing is models allow you to take your intuition, and I think this isn't the case in physics. In physics, some models really are used for predicting the future. In finance, I think models allow you to take your intuition and convert it, your gut feeling about the world, and convert it into what you should pay for something. Yeah, I think part of the trouble is that in physics, you really ultimately can assume that you can find models that work really, really well. And as I said, sometimes there's a very small gap between a good theory and between the world itself. People think the world really is made out of atoms and forget the fact that atoms are actually a theoretical construct to some extent. And the way you see atoms is only by shooting particles at other substances and seeing them bounce off and deducing that somewhere inside there must be something you call an atom. But it's also to some extent, not to some extent, it also is really a theoretical construct that's been validated. But you never really get that kind of certainty about what you're seeing in finance, and I'm going to talk about that more later. So let me compare a little bit. I said, so the dubious foundations of quantitative finance. If you talk about science and physics, then science is sort of reductive in that if you look at physics, as I said, you have Newton's laws or quantum mechanics or Maxwell's theory of electromagnetism. And in all cases, at least with fundamental models, which is what everything is built on, you're trying to discover the ultimate laws in a reductionist sort of way that describe, in a shorthand way, you can write down a law that, as somebody once said to me, is just a couple of inches long and hopefully explains everything in the world. And that's reductive. And engineering is sort of the other way. It's constructive. It takes those laws and then tries to figure out how to build devices that are based on those laws. So if you think about mechanical engineering, for example, mechanical engineering is based on something pretty solid like Newton's laws, plus maybe some heuristic or empirical experience about friction and viscosity that maybe you don't understand that well, but empirically you know how they behave. And then you figure out how to build bridges or how to build airplanes, and it works pretty well. And there's a solid scientific basis beneath the engineering. In the same way, if you look at electrical engineering, which is concerned with building electrical devices like radios or power stations that in some sense are just isolated parts of the universe that have been put together in a way that then satisfy the laws of the universe, but given the initial conditions, they do something that you want. Machines really are little isolated parts of the world that are just carrying out the laws that that determine them. They perform in desired ways. It's also built on a good foundation, which is Maxwell's equations, and maybe quantum electrodynamics as well, and you have a good foundation for trying to build these things. So then you look at financial engineering, and although everybody calls, I used to think it was when I first went into this business, thought that they should call it financial science, but I actually decided, I reluctantly got persuaded that financial engineering is a better word for it, although it doesn't sound as glamorous. When people start out in science, they tend to look down on engineering. So what's the science beneath financial engineering? And you sort of come up with a whole in some sense. If you think about Brownian motion or diffusion, which is the standard model that underpins much of quantitative finance, it's accurate science for small particles that are bumped around by atoms, which is what Brown originally saw. But for stocks, geometric Brownian motion is really a very idealized approximation. And while it's a sort of while it's a reasonable description of risk and of the motion that stocks undergo at normal terms, I'm not telling you anything you don't know. It's a pretty bad approximation for what we've seen in the last year or two, and what one sees quite often, in fact, even for single stocks. And markets are sort of plagued and blessed with all sorts of anomalies that don't satisfy the standard theories of quantitative finance at all. And while we've got lots of techniques, and they're written down in mathematics that looks a lot like the mathematics one uses in physics, the predictability isn't the same at all. So what solid laws, what I'm trying to say is there's a big question mark underneath financial engineering, and much as the syntax of what you teach in courses in financial engineering looks a lot like the syntax in mechanical engineering or electrical engineering, the actual semantics is very different and nowhere near as accurate. You can't really tell whether a stock is going to go up or down tomorrow, whereas you can tell what a satellite is going to do. So let me talk about what I think the laws of financial modeling are. I once heard a talk by Andy Lowe, who's a professor at MIT and also ran a hedge fund for a while, who says that finance suffers from physics envy. And then he tells the story where he says that, let me see if I can get it right, otherwise it's going to come out badly. In physics you have 3 laws which explain 99% of the phenomena, but in finance he claims you have 99 laws which explain about 3% of the phenomena. I think even that's an exaggeration, actually. I really like to say that there's actually only one law. I agree in spirit, but I think there's actually only one law in financial engineering or in finance that's at all reliable. When I was a kid, I went to Bible school, and they used to tell us a story about somebody who was asked to recite the essence of God's laws while standing on one leg. I don't have that up there. And he said, let me quote it rightly. He said, don't do unto others as you would not have them do unto you. All the rest is commentary, go and learn. And that's supposed to be sort of the essence of the 10 Commandments. And I like to think that you can summarize all the laws of quantitative finance while standing on one leg too. And this is my version, which is over there, which says if you want to know the value of a financial security, and this is related to structured products, if you want to know the value of a financial security, use the known price of another security or another portfolio of securities that's as similar to it as possible. And all the rest is modeling, so go and build one. And really this is just a fancy version of the law of one price, which I've got below, or the law of no arbitrage, which says that any 2 securities with identical future payoffs, no matter how the future turns out, and that's the key part, no matter how the future turns out, should have the same identical current prices today. The wonderful thing about this law, and I really think it is the only law that we have in quantitative finance, the rest is all technique, is it's really valuation by analogy or valuation by metaphor, saying if you want to understand this thing, you can think of it a lot as being like the other thing if they have the same payoffs. And I say the great thing about it, as compared to almost everything else in economics, is that it doesn't talk about utility functions or people's preferences or all sorts of unobservable hidden variables which are probably there but which you can't really measure, and nevertheless permeates most of sort of faux accurate or faux quantitative economical theory. And really all that's there in the end that you can rely on is that if 2 things are similar to each other, they ought to have the same price. And as I say, this valuation by analogy, it's not really a law of nature like Newton's laws. It's really a phenomenological law of relative value, and it's just a general reflection on the behavior of human beings who, if they see a bargain somewhere or other, and they've got the time and energy and the money to do something about it, will try to grab a bargain when they see it. It usually holds in the long run, but it doesn't hold in the short run, as we've all seen, and doesn't hold unless markets are pretty liquid and well-oiled, and there are always longer-term exceptions that last for a long time. So how do you use this one law to actually build financial models? Where do models enter? What you have to do is, if you've got some target security, which let's say is a structured product, a barrier option that you want to value, and you don't have a liquid market, so you can't tell what the price is, you have to try to construct a portfolio, so-called replicating portfolio of other securities that are more liquid and that have similar payoffs. So you might have a barrier option. You might say I can replicate it with a zero coupon bond for the and a collection of ordinary options. Or you might say I've got a Black-Scholes option and I can replicate it by dynamically trading in a stock and a bond. And what you have to do then is show that the target security, which is the one you're trying to value, has the same payoffs under all circumstances, as I said, as the liquid securities that are replicating it or that are attempting to replicate it. So you need two things. One, you have to specify what you mean by all circumstances, and that's really where all the complicated mathematics comes in that you have to write down the stochastic process or specify the stochastic process that says what you mean by all circumstances, meaning no matter what the world does in the future. And then you have to construct a replicating portfolio, which is the engineering. So the first part is the science, in a sense, which says these are the assumptions I make about the stochastic behavior of the markets or parameters in the future. And then the engineering is, if I put together this particular portfolio, say I put in a call to make a future or forward contract or dynamic trading in a stock and a bond to replicate an option, then I'll be able to replicate the portfolio. And most of the mathematical complexity is involved in specifying the stochastic processes and the circumstances, and most of the engineering is involved in then trying to put together a portfolio that, under those circumstances, actually behaves the way you wanted. The tricky part is really specifying all future circumstances. In Black-Scholes, all future circumstances means no jumps, constant volatility, no transaction costs, smooth movements, able to short as much stock as you like. And of course, that's not exactly true in the real world, especially in the world we're living in today, when even regulatorily wise for a while, you can't short stock, which affected the convertible bond market in a big way. This always reminds me a little bit of a movie that I saw years ago. I think there was a reissue of it. It was called Bedazzled with Peter Cook and Dudley Moore. I don't know if anybody remembers this. It's probably 30 years old, and they're both not alive anymore, I think. But anyway, it's a retelling of the story of Faust set in London in the 60s, and Peter Cook plays the devil, and Dudley Moore plays a short order cook in a Wimpy's. I'm not even sure if Wimpy's still exists, but they were sort of fast food restaurants in London. And he's the guy that flips the hamburgers, and he's in love with the waitress, but she's not interested in him because he's really not very glamorous. And at some point, the devil comes down to him and says, if you give me your soul for eternity, you can have 7 chances to seduce her, so to speak. And he jumps at the opportunity, and he signs on the dotted line and gives his soul to the devil. And then the devil starts to give him his 7 opportunities to get the girl he wants. And so the first thing he says is, he specifies these scenarios, and he says, okay, I want her to be in love with me and me to be in love with her, and both of us to be wealthy and be somewhere in a fancy castle in Oxfordshire, and us to be in love with each other. And the devil snaps his fingers, and they're both in a fancy castle somewhere, both dressed in, him in a tuxedo and her in an evening gown, and they're playing billiards. But she's married to the owner of the castle, and he's just a visitor. And so he's never able to specify it, and she's also got very high principles, so nothing ever comes of it. And so then he keeps trying successive scenarios, but every time he gets something wrong, and I don't remember them all, but the last one he finally, in frustration, says, I want us to be somewhere where there are no other people around and nobody to disturb us, and in love with each other. And they both end up being nuns in a Trappist monastery. He forgot to specify the gender. So it seems to me that's a lot of what's gone wrong with models in general, is that the world always outwits you, and no matter how hard you try to specify what you mean by all circumstances, you really can't get it right. If you use Brownian motion, you're going to get jumps, and if you use jumps, you're going to miss something else. You're going to miss the fact that there's no credit or there's illiquidity, and nobody can ever really get it right. The world's just more complicated than you can imagine, and certainly then you can write down in an equation, and markets always outwit you. I want to also talk a little bit more about the difference between physics or hard sciences and finance, and specifically about model risk. And I said one of the big differences is that science, I said before, is reductive, and science somehow has figured out a way to deal with the world, and it deals with it on two levels. One, people sit and theorize and make up. If you look at things like Newton's laws, nobody in their right mind, or nobody at all, could possibly look at the planets and say, "Oh my God, force equals mass times acceleration." It's obvious. There's no way to do that. There are really moments of inspiration that I think scientists have that come. I don't know where they come out of, but they don't come out of straight empirical observation. And then they're able to use repeated experiments on relatively isolated systems to do the same experiment over and over again. So at CERN in Geneva, you can take protons and fire them at a target over and over again. And the fact that it's hotter one day or colder the next doesn't really matter very much, or who's in the room, or whether there are 20 or 10 physicists in the room, because by and large the whole system's fairly isolated, and history doesn't matter. You can repeat the same experiment over and over again. Or if you flip a coin, you can do it over and over again and get the distribution of heads and tails, and the fact that the lights are on or the lights are off doesn't matter too much, or what happened yesterday. Economics is very different. It's sort of, you can't decouple systems, and there isn't really, history isn't independent. You can't do repeated experiments. And so even if there were a good scientific basis for economics, which I don't think there is, as I said, there are very little laws, it's very difficult to find isolated systems. If you look at what happens to the market today, it really depends upon, the market's in the end made up of people, and depends about what happened to people yesterday, and they remember it, they don't forget it. And so history is important, and you sort of see it. It's almost funny when you look at what people are trying to do about the bailout now, in the sense that to some extent the financial problems were caused by too much easy credit, and so too much easy credit caused the problem, and now people are trying to cure it with making credit easy again. And so clearly the initial conditions, if all you do is think about making credit easy, the initial conditions are the same, but you're hoping for a different effect, because in fact the whole history of what's happened is important. So you can't replicate initial conditions over and over again as you can with either particle physics accelerators or flipping coins. Human beings basically learn and remember, and physical systems don't. And as I say, people learn with financial models. If you look at the Black-Scholes model, it used to be more or less okay in terms of describing the shape of the volatility surface until 1987, after the crash. And ever since then, even if people haven't necessarily changed the Black-Scholes model, when they filter prices through it, they now put in a whole volatility surface that has different implied volatilities for different strikes. And nobody would dream of valuing, in the end, a complex structured product without taking account of the fact that different implied volatilities have different strikes, which in a sense says the model is wrong, but in another sense says people have learned in an approximate way how to work their way around their first order approximation to the model and accommodate for it, and eventually build more sophisticated models. So in a sense, what one faces, I like to distinguish between risk and uncertainty. And risk is if you know the price of IBM today and you know exactly what its value is today, but you don't know what it's going to be tomorrow because the trade hasn't happened yet. And so knowing something today but not knowing what's going to happen tomorrow, that's risk. What you deal with a lot in models, when people talk about model risk, is it's really not model risk, it's a misnomer, it's model uncertainty, or it's ignorance, in the sense you don't really know what the right price is today because there wasn't a last trade, and you're relying on models to tell you that, but you don't even know what the right model is because these models don't describe the world accurately, they're only approximations, and so you really face uncertainty, which is much worse than risk in a way, and it's dangerous to forget it. And I think as a result, people who come from physics into finance sort of understand after a while that the techniques of physics hardly ever produce more than the most approximate notion of what's correct in finance, because true financial value is sort of a fiction in itself. In physics, a model is right when it can predict where a rocket is going to go or what new particle is going to come into existence and be proved right. In finance, as I said, you can't easily prove a model is right because you can't repeat experiments, you don't have good data. Markets aren't stationary. The universe's laws seem to remain the same over and over again, whereas I said with easing credit once or easing credit twice makes all the difference as to what happened before. And so there's action and reaction, and the world keeps changing as a result of what's happened before, and people learn from their past mistakes but go on to make new ones. And so I think people in physics, if they've worked in finance for a while, they very quickly learn not to expect too much and to understand that they're not finding theories, they're building approximate models. And I think sometimes, in my experience, either physicists who've come at the beginning who come to the market, or economists who've theorized a lot but never actually, sometimes in academic life, but haven't seen this, often, I think physicists have one advantage, which is that they've seen a first-class theory, which is Newton's laws or quantum mechanics, and seen how accurate it is, and as a result, they don't expect too much from the models they build in finance, and they understand that they're approximations and phenomenology. And it's not that economics is worse in any sense. I think economics is tougher, because in some sense in physics you're playing against God, and he doesn't change his laws all the time. And when you guess them right, he doesn't change his mind. He just sort of says, I give up, you know, you've got me. And when you work with people, they keep playing even if they've lost the game, and they respond to ephemeral events, and they respond to feelings and to what they think other people's feelings are going to be, and they don't even know when they've lost. They keep trying to play, and so it's a much harder field to work in altogether, and your ambitions have to be much lower. How much longer do I still have? I'm not sure. 15 minutes of talking? Okay. Okay. So let me talk a little bit about CDO models, and then I'll wrap up. I'm not a big expert on CDO models, but one thing that I think has gone wrong is that, and I think this is true a lot of the teaching of finance in general, is that, to be a little bit poetic, I think it comes from William Blake, but I think a lot of finance has got a dark secret love of sort of too much inappropriate mathematical elegance and exactitude and too much precision. And I'm always sort of surprised when I see students now that if you say to somebody, if you ask somebody, I used to interview people a lot at Goldman, and if you said to somebody who came from physics, why can you tell me why you think we can shoot a rocket to the moon, or what allows us to shoot a rocket to the moon, and they would say Newton's laws, and that's like a reasonable answer. But if you would see a lot of people who come out of very mathematical finance programs, and you would say to them, why do you think, explain to me, I'm a smart person, but I don't really know much about options, tell me why you think you can value an option. And I promise you half the people would say because of something called Gersanov's theorem. And Gersanov's theorem is some very complicated measure theory theorem about probabilities, and they seem to think that that was what allowed you to value an option, instead of really saying because you can replicate it or something like that. And I think they've sort of been taught badly, in the sense that finance is all about money and economics and people, and yet people are being taught it in a very axiomatic way. There's a statement from Aristotle that said different endeavors require different degrees of precision, and I think that's true, and people somehow get too carried away. You have to use models, but people get carried away by attempting too much inappropriate precision in finance, and especially in teaching finance. And I think to some extent this is what happened with CDOs. They apply probability theory and correlations to very complicated tranches of structures. In the end, statistics is really, it doesn't have causality. It's too shallow a description to really take seriously about, I'm not saying it's a bad way to come up with an estimate for a price, but it doesn't have the cause and effect and dynamics that you have in physics, or even that you have in things like the Black-Scholes model. And I actually like the Black-Scholes model, and people often make what I think are spurious analogies between Black-Scholes and between CDO models, in the sense they compare the default correlation in CDO models to the implied volatility in Black-Scholes models. And I think it's a bad analogy, because it's an attractive analogy and it's a seductive analogy, but it's not really an accurate one, in the sense in volatility markets, A, you can really measure realized volatility, and B, you can really measure implied volatility in at least in the liquid equity options markets or in currency markets. And so you can see implied volatility and you can see realized volatility. And in correlation markets, and especially in default correlation markets, you can't really measure default correlations because defaults occur so rarely, and there isn't really a liquid market in implied correlation. And so even apart from the fact that the model is simplistic and a correlation model and not a replication model, the way Black-Scholes is, there also isn't enough information out there. So I'm not saying it's wrong to use models, but it's not surprising that they fail and that they're less reliable. I was going to say something else. Oh, okay. So let me finish by talking about what I think is the right way to use models. First of all, I want to say something sort of from an introspective point of view. If anybody's ever been in biology or physics or one of the hard sciences in which the scientific method works, if you're in physics and you wake up one day and you think of a theory and you say to yourself, well, you know, supposing everything's a string or there's a principle of least action or something like that, it doesn't sound totally ridiculous because you've seen people like Feynman or Bohr or Newton or Schrödinger or Heisenberg or Planck write down what sound like very deep statements, and they actually turn out to be right, and it's sort of astonishing. And so if you write down something like that yourself, and you're a research scientist, even if you know there's a high probability that you're wrong, there's a small chance that you're right, and it's not a totally ridiculous sort of ambition to have. But if you wake up and you write down an interest rate model, and you say one day you're trying to value mortgages, and you say, let's assume all interest rates, let's say all bond prices depend only on short-term rates, and short-term rates evolve log normally, and nothing else matters, then if you're honest and you look into your heart, you say, this is like nonsense. There's not a chance in hell that this is actually true. This is only a model. There's no way people really and truly behave this way. And so that's the first thing, that you have to keep that in mind and realize that nothing you say can possibly be true. The second thing I've already said is, I think it's a bad idea to be axiomatic. Paul Wilmot, whose sort of books I like, always says that, let me see if I can find the quote. Yeah, he says, every financial axiom I've ever seen is demonstrably wrong, and the only interesting question is how wrong is the theory, and how useful is it regardless of its validity. Everything you read in any theoretical finance book, including this one, you must take with a general pinch of salt. And I think that's right. And so I sort of don't like to look at a lot of papers. If you look at some of the very fancy journals in quantitative finance, they look a lot like Euclid in the sense they have theorems and lemmas and axioms, and it's kind of a strange way to teach a subject that if all of the axioms are false, it's a strange way to teach a theorem as though it's teach a subject as though it's pure mathematics. And it's funny, theoretical finance papers often look more theoretical than physics or applied math papers, and the rigor almost seems to be inversely proportional to the efficacy with which you can apply it. The other thing that's different from physics and finance is, I've got the second bullet point there which says use vulgar variables in a sophisticated way. And what I mean is, in physics, as I said, for some, God knows, and really only God knows why, people can sit down and write down some general principle like Newton's laws, which have nothing to see, which have nothing obvious, no obvious connection with what you observe, and write down something deep. And so you can start with the surface, drop down to some very deep level and write down some law, and then pop up again and work out its consequences. And it's amazing, it actually works some of the time. I think in finance that works very badly, and what works best are fairly shallow models, and I don't mean shallow in a bad sense, but I mean models that stay on the surface and go directly from what you can see to what you want to calculate through some sort of replication mechanism, which is fairly crude. And if you try dropping down and writing very sophisticated, I know people who first come to work in finance and see Black-Scholes and say, gee, that's clever, but you know, really interest rates are stochastic and volatility is stochastic, and there's a correlation between them, and credit spreads are stochastic too, and they suddenly, all of these things are true, but if they try to build a model that describes the dynamics of all of these stochastic variables, you end up with a model that's so complicated it doesn't do you any good at all, because there's no way you can get the dynamics right. And a simple model like Black-Scholes, with only forcing you to put all your intuition into one variable that somehow has to capture it all, is actually much more effective in staying on a shallow level. It stays much more robust. The third thing I think that's good about Black-Scholes is that all models, as I've been saying, sweep dirt under the rug. And that's by definition what a model does. It ignores a lot of things. But what's nice about Black-Scholes is that it sweeps dirt under the rug, but it sort of tells you exactly what it's sweeping under the rug. It's sweeping under the rug any complications in dynamics other than pure Brownian motion. If you look on the other hand at CDO models, they don't really have dynamics. They're just telling you you can substitute, you can force everything into a default correlation. That's the same for all the different bonds under default or companies under default, And it's very unclear what you're losing when you use copulars or when you use these models. And what I like about Black-Scholes is that you understand much more clearly what it is you're assuming and what it is you're ignoring. And I think that's what makes a good usable model. I think many people imagine that one day, and then you can overlay it with common sense. Many people imagine that one beautiful day we're all going to find the right model, but I think there really is no right model because, as I said before, the world keeps changing in response to what people learn over time, and markets change. And so progress in financial models is kind of temporary in the sense you get more sophisticated, but the market gets more sophisticated too. And nobody's going to wake up one day and say, this is the way stocks evolve. I now know exactly how I should price things. There's always going to be a need for somebody to overlay the model with common sense and market experience. So I actually think, and I think we used to do this when we worked at Goldman Sachs in risk management. I like to think of models as what physicists sort of 110 years ago called Gedanken experiments, which are imaginary experiments or stress tests. If you think about Einstein, maybe he was in Zurich, I don't actually know at the time, but was supposed to have come to some intuition about the theory of relativity by imagining that he was sitting on the crest of a light wave and imagining he was traveling along at the speed of light, and realized that if he was on the wave itself, he wouldn't see the wave undulating at all. And so there was something wrong, and this somehow in his intellectual biography is supposed to have led him to some idea that the speed of light had to be constant for everybody. And Schrödinger has this famous example of Schrödinger's cat where in quantum mechanics things can exist simultaneously in many states and oscillate between them, and then he thinks about what would happen if a cat, which it is, were really a quantum mechanical object, and you put it in a box and you seal the box, and there's a radioactive substance inside there which, if it decays, will trigger a Geiger counter that will then release poison that will kill the cat. But until you open the box, you don't know whether the cat's alive or dead, and you really have to think about it as satisfying a Schrödinger equation with a wave which is sometimes alive and sometimes dead with some probability. And these are sort of imaginary experiments that you could in principle do, but are too complicated to actually do in practice. And I think I like to think of models in the same way too, in that none of the models you write down for equity evolution or for structured products or for fixed income or for currencies are really going to be the correct model. You're always trying to take a very complicated world and shoehorn it into something much narrower. And what you have to understand is, it's like the stepsister's foot in Cinderella. If you're trying to fit her foot into Cinderella's beautiful shoe, you have to cut off some toes or cut off some parts of the foot to make it fit. And in doing that, you inevitably, when you force the world to fit into a model, unlike in physics probably, but in finance or any of the social sciences, you're inevitably losing some of the risk and ignoring things, and it's very important to understand what it is you're ignoring. And so the best thing to do in a way is to think of all of these different models, whether they're stochastic volatility models or Black-Scholes or local volatility models, to understand that each one of them should be internally self-consistent, but it's never the whole world in itself. And we actually used to do this when I worked in risk management. You should probably value the same structured product or whatever it is you're looking at, if it's not liquid, in several different models, and get some sense of what your model uncertainty is and some understanding of how wrong you might be, since the world may satisfy one of these models at one time and a different one at another time, and none of them are actually going to be right. And so you want to be reasonably eclectic and not be too bound by any preconception about any particular model. So I think the biggest danger is actually, I was going to say, I think the biggest danger is actually idolatry, in the sense that God or somebody else, in any event, you didn't make the world yourself, and the big danger is to imagine that the models that you write down the world is constrained to obey them. You want to be simplistic in building models, but the world itself isn't simplistic. And if you end up trying to believe that your models that the world obeys your models, you're destined to get into trouble sooner rather than later. On the other hand, it's sort of a narrow line, it's a wavy line. You want to be confident. You want to use models. You want to use hubris and assume that you can push your model as far as you can go. And I think in a way the triumph of options theory, which is certainly the best quantitative theory in economics, despite everything, is that people take it very seriously and push it as hard as they can. And I always like this quote from, I think it's what we've done with options theory. There's this line I like from William Blake, which says, if a fool would persist in his folly, he would become wise. And I think that's what you're doing with option theory. You're taking a Platonic model and then taking it as seriously as you can and pushing it and using it over and over again, persisting in your folly. And it lets you do all sorts of wise things in the end and value things you couldn't value otherwise. But at the end, you have to turn around and say, this is only a model, and at some point it's going to break down. There isn't a theory of everything. There may be a theory of everything in physics, but there isn't one in finance. And so you have to walk a narrow line, and somewhere north of hubris, but sort of south of idolatry is the range in which you have to operate, and that's what using models in a wise way constitutes. I think I'll stop over there, thanks. I'll be happy to take questions if anybody has any. The trouble, to be honest, the trouble with local volatility models is I think they're better than Black-Scholes, but they're also limited in the sense that they don't allow volatility itself to be stochastic, and volatility is stochastic. And so it kind of works well for markets like fixed income markets and some equity markets where volatility does seem to be a function of market level, and it works badly, say, in currency markets where volatility tends to be much more stochastic. But in the end, now I'm sort of bad-mouthing my own model, but I think in the end, what's frustrating for me about finance is that Black and Scholes developed this whole idea of replication or dynamic replication. There was static replication before that, but dynamic replication, Black, Scholes, and Merton, sort of 1973 or 72, and it's 35 years. There was a conference in Nashville about 2 months ago about 35 years of Black, Scholes, and everybody operates in the same paradigm, which is write down, it's what I said, write down a stochastic process that's as realistic as you can, and so local volatility is more realistic than constant volatility, but maybe not as realistic as you could be, and then calibrate the model to liquid instruments, and then use it to price illiquid instruments and calculate hedge ratios. And it's sort of the same paradigm over and over again, just moving to currencies, to fixed income, to inflation derivatives, etc. And so I wish somebody would come up with something new, but I'm not sure what that's going to be. I'm not sure if I'm answering you properly either. But I think what's missing is a better theory of underliers. We all know how to handle derivatives, and even if we don't have the best model, we know how to improve them. When a volatility skew comes along, you add local volatility or stochastic volatility. But nobody has a really good theory of underliers, and the big problems are how do underliers behave, and then illiquidity, which I think nobody knows how to deal with in any quantitative way.